All right, guys, let's get started here. It's 1 o'clock on the dot Eastern time. So first of all, thank you all for joining today on this webinar regarding Heritage Square, our newest opportunity. We're very excited to have you on right now as we go through this process and how we found this deal, the business plan, the market, and really kind of the reasons why we're so passionate about this opportunity. Let's get started right now. So I've got Chad here as well on the line. I'm going to do a quick introduction with him here in a second. Quick disclaimer for you. This presentation is just a summary of this offering. It's any kind of returns discussed we have to disclose are just estimates. Therefore, we can't make guarantees or any kind of projections. That's what they are. So if you have questions at all on this, anything on the deck here, you can reach me after we're finished, and we'll go over it in detail with you and who else you want to get involved. First of all, quick introduction here. So obviously, a lot of you guys already know myself, Chad. I'm the founder of Focus Capital. I lead the team here. Quick background on myself is prior to real estate, I spent about 18 years in the electronic payments industry, and I focused really on helping businesses with the credit card processing systems, built a nice portfolio of business there for my family, and helped a lot of people along the way. Had a lot of loyalty with those clients too. At about year 2017, I realized I had a big tax problem to solve, and I realized that real estate would be a way to help solve that for myself, my family. And through the course of buying a few deals on my own initially, I realized I can create a company out of this and help more people than just myself, help impact investors and employees, and also now residents in our communities. I live in Fishers with my wife and daughter, my son, little kids right now, 5-year-old and 8-month-old. Chad Olsen is our Director of Acquisitions here at Focus Capital. Chad, give a quick introduction if you don't mind, please.
Yeah, so I've been at Focus Capital for about a year, taking over anything from acquisition, sourcing and finding deals, initial construction estimates, debt placement, and everything else. Prior to this, I worked at a local real estate developer that has a national presence, Thompson Thrift, as an acquisition manager for them. I was focused mostly out west, and they build luxury A-class multifamily. Yeah.
Awesome. Thanks, Chad. Yeah, you came aboard almost a year ago right now, so it's been a fun ride. So here is the offering summary for you guys. So we've got a core plus Class A asset, 183 units in Sellersburg, Indiana, which is in the Louisville MSA. And it's important to reference this because it's 9 miles over the border from Kentucky and Indiana. We'll get more of this later on, but Indiana is really a more appealing state to live in due to its cost of living and more flexibility in tax treatment. But this deal is especially important to us because not only have we acquired this deal at a large discount to replacement costs, and it didn't come at no expense to our efforts. We've taken over a year here to find this deal and get it locked under contract. But also there's a moratorium right now in Sellersburg and the surrounding areas, not only for last year, but also this year in 2025. That's important to note as well because there'll be fewer supply coming on board, which will increase demand for this current asset. And Louisville market itself has been one of the leaders in rent growth in the nation in the last couple of years, which is exciting to us as well. There's a lot of growth fueling there with the River Edge Commerce Center, 18,000 jobs going in right now, 12,000 which have already been created, and 6,000 still to go. So we have an A-class unit property here built in 2023, 2 years old. The current seller is the developer. He's a merchant builder. This deal is projected to do a 15% IRR over a 5-year hold. We're raising $11.3 million between investors. Over a 5-year period of time, it's projected to have a 1.9 equity multiple. Obviously, we hope to outperform this deal as we have in the past, and the minimum investment is $100,000. So I want to talk for a moment here about why Heritage Square and what's so rare about this opportunity and why does it matter so much to us? I mentioned briefly here a second ago that when you can get a brand new or 2-year-old asset below replacement cost at $146,000 a door, you've got some built-in upside already. You have downside risk protection out of the gate. To build things brand new right now, you're looking at between $160,000 to $180,000 per unit, plus your land and soft costs. So that's going to be a great place to be in to have more cash flow out of the gate. It's also very rare to find a newer Class A asset like this that has such a high going-in cap rate. And we'll get into more of the story throughout this presentation as to how it came about and why there's a high cap rate. But essentially, we've got an opportunity now to acquire a property to where our interest rate is lower than the going-in cap rate, which essentially is outperforming value-add type deals that take more risk. We have great positive leverage here, like I mentioned. On the seller's T3 financials, it's around a 7 cap. On our numbers with our expenses year one and the seller's income T3, we're over a 6 cap. And debt right now is shaking out in the low fives with the agency debt. This property is already stabilized. It's 95% occupied right now today. There's no renovations that have to do the property whatsoever, major ones rather, small repairs possibly, maybe some paint. This is more of an operational play. Chad, if you wouldn't mind, why don't you go through more of, why Class A and how do they compare to value add, and why is this strategy going to be great for our opportunity here?
Yeah. Yeah. So typically we're buying value add deals, and that's what we spend most of our time looking for. But we obviously are always looking for any kind of opportunity that sits above that or provides excess returns with mitigating risk. And I think this one really checks all those boxes, as kind of Chad alluded to. So when it comes to value add deals, you're looking for, and then what they're trading at right now, we've seen cap rate compression the last, 5 years, where cap rates, capitalization rates have really come down, and there wasn't a big difference between the A class, B class, C class, or core plus deals and value add deals. And over the last year and a half, they've started to expand for sure, but value add deals are still trading in the 6 cap range, 6 to 7 cap range, especially for that 2000s and 1990s vintage. With us getting a class brand new vintage in the 6 caps, that is pretty much unheard of. Most of the time, these A-class deals or newer vintage deals are trading in the low fives. We know of another deal not far away that would have been under contract for sub 5. So that's where the kind of cap rate and the opportunity in relation to older vintage feels really strong. The next part is kind of the recession proof or recession resilient. With having A-class, and as a kind of supply has expanded in the market, and if you have rents coming down, the people that live in the B and C class will start to move up. And everybody wants to live in a better or newer place. And so us having that, getting at this right cap rate, even if the market was to kind of move to the sideways or move downward, we should still have a very quality asset in the area that will attract a lot of tenant base. Kind of piggybacking off of what Chad said with the 146K per unit and that going in cost, that below replacement cost. And so one of the things that he highlighted in that first bullet is the 160 to 180K hard cost. Now that's for foundations and up, sticks and bricks, doesn't include your land cost, doesn't include your soft cost, doesn't include all those other things and fees that go into that. So that cost can move up, and we're getting this at 146. I don't think, and anybody on this call probably doesn't think, that construction costs are going to start going down in the next years to come, especially with the kind of headwinds of tariffs, other inflation, construction, and what we've seen the last few years. So getting in at a really good basis where it's already stabilized takes a lot of that risk off that you would normally do with a development deal or so on and so forth. With it being stabilized at 95%, we're not going through the same thing that we do on a value add, where we're going to take units down or do our occupied reno that limits some of that risk. But we don't have that same lease up risk and moving these to a new market rate that the tenant base in the property is not experienced to, or the surrounding area. We've done really well at that, especially in our Kokomo property. But for this, it's a very small adjustment of around $50 to $75 that we're looking to bring the rents that are currently in place to market. Most of the work is going to be in the expenses, operating and managing the property correctly, and then other income and ancillary income additions to the property. With interest rate risk, we're on this one, we are usually very interest rate and risk averse and staying away from bridge and variable debt as we have in the past. This is a continuation of that. We're going straight to the agencies. We're going to work with Fannie Mae as it sits right now. And so we'll have a fixed rate with a very favorable spread that we're going to capitalize on and have that fixed for 5 years during the whole hold period, and feel really good about where that's sitting at right now.
Awesome. Thanks, Chad. Let's go through some of the return projections, and we've put together some more of the sensitivity analysis based upon how would the returns still work out if we were at a different exit cap rate when we sell the property. And for those of you that may not fully understand cap rates, and a cap rate is simply a multiple by which the net operating income is applied to, and that gives you the valuation of the property. So here we've got a few different scenarios, and whenever we're going to go after properties and put together a business plan, we're looking to get a double. We're not looking out to get triples and home runs, although we hope they turn into those. Our goal is to come to you with a double, a conservative double, to where we have room to outperform. We've put in layers of conservativeness in the business plan, and we can do better. So for a double here, we feel like we've got a pretty high probability to achieve a 15 IRR and a 1.9 multiple on your investment over a 5-year period of time. And that's based upon an exit cap rate of 6%. And right now, we feel like that's a very appropriate cap rate given the market. Now, let's say that the cap rate on exit, we can only get, it's a 6.25, for example. That does not change the numbers drastically. It does go from a 15 IRR down to a 14.18. So I hope this gives you some clarity here on how things could shift in either direction if we're able to get a higher a lower cap rate upon sale. Chad, you want to add anything else to this piece?
I think you pretty much summed it up great. It's just, right now, as I kind of alluded to in the last slide, cap rates, as of we sit right today, is 5.25 to 5.5 for A class. And so we, generally speaking, are always just adding a certain amount of basis points over the hold period to adjust for where those cap rates are going to go. And that's pretty standard. It is very hard, in the same way that it's hard to predict where interest rates are going to be 3-5 years down the road, as we've seen the last 5 years. So we do it more so on what's that income, what's that cash on cash going to deliver, what can we expect on the property today, and let the market take the rest of the way. But we think a 6 cap is very conservative, especially from what we've seen other places in the market where people are looking at these things, where people are trading other deals at, for a property that is stabilized, that hasn't had this year-long process to get tied up. We feel really strongly about where a 6 cap will end up. And then on the basis conversation, again, most of the time it costs 160 to 180K a build. We have several deals that are 2022, 2020 vintages that have sold at 180,000 or more in the last year and a half. And so for us to exit, that 6 cap will be roughly 200,000 a unit. We don't feel bad about that 5 years from now, pending all of the same construction costs, inflation, tariffs, all of those things remaining the same, or even slightly getting better. A 200,000 a unit exit, it does not feel too ambitious whatsoever.
Awesome. Thanks, Chad. Let's go over a few more of the details here on the returns themselves. Over the 5-year period of time, we're projecting to have a cash-on-cash return for you as a limited partner of 7% over the hold period. This deal is going to give out an 8% preferred return to limited partners, and an 80-20 split of the cash flows up to a 15% IRR. Once we achieve that, it'll be a 50-50 split with the LP and GP thereafter. I think it's also important to note here as well that the order in which that the returns are paid out for distributions is, first is the preferred return, followed by full return of your capital back to investors, and then we do a split. That is different than what some companies do. We are giving all of your principal back to you before the GP makes their split at all on the investment. We've got a 5-year sample investment return projection here showed you as well, to where over a 5-year period of time, your projections would be year one, cash flow of around $6,000 year one, $100,000 investment. Year two, $7,472, and so forth. And we plan to sell in year 5. And again, these are projections. We hope to do better than these, but these are just projections for your reference point. The business plan. So like Chad mentioned, we typically do value adds, or bread and butter. We go through and renovate the units. We grow the rents. We transform the property, amenities, marketing, signage. Chad, give us a little more background here on what our business plan is at Heritage Square.
Yeah. So part of that story that we've been talking about is that the developer owner of the property was doing everything in-house for the last couple of years and through the lease-up phase. And in a lot of ways, that cost them pretty slow lease-up and kind of where the rents sit now. We are bringing on third-party management, and part of this kind of transition and part of the sale, they've already kind of come on board a little early, which is a little unorthodox, but it's definitely helping us up and giving us better insight into the property and starting off the motion to enhancing it, right? So the third-party management coming online, professional, they have a really strong presence down there, manage about 9,000 to 10,000 units total, and the bulk majority are in the Louisville. They're based in the Louisville MSA. The CFO himself lives about 2 miles down from the property, so we know we're going to get a lot of eyes on. So that's kind of the first part, just bringing in professional management and taking over the asset. With that, those are the doing it in-house, they haven't spent on certain things. They've cut costs in certain areas. You can see that in our financial model when we get there. There's no payroll reflected, for example, because it was shared inside the construction company or on these other properties. So we know that we need to spend money to enhance this property, to drive qualified leads and everything else. So we definitely want to spend money on marketing, for example, and implement a really good marketing initiative. The website before wasn't really that strong. So those are kind of just to build out the rent roll, right? The rest of the work is going to come in on other income and ancillary income that I talked about. One of those big drivers is going to be a bulk internet package for Class A assets or brand new builds in this area or across the country now. It's become pretty standard that internet is looped up into your rent as an option, and the apartment community has already signed up for a bulk internet package with a service provider. Spectrum already services the site. We've already had preliminary conversations with them to kind of take over that, but it's going to give us a pretty nice line item and profit per unit when we implement that. Outside of that, it's improving the RUB situation that's on the property, bringing that up to a normal market rate, and then just different rental insurance options, CAM fees, these kind of things that we've used successfully on other properties. And then, as I said, putting in the correct expenses that should be on the property and then managing those well.
Thanks, Chad. Appreciate that. Site comment, if you guys have any questions at all on the business plan or some of the details there, remember to put them in the chat here. We'll do a Q&A for a finish here in about probably 10 minutes. So the property, to give you guys an example of how it looks, I mean, it's a beautiful property. They did a really good job on the aesthetics here. The kitchens are amazing. We have granite countertops, stainless steel appliances, nickel plated finish plumbing fixtures. We've got great cabinets here, shaker cabinets. The community center is great as well. It's a nice place for people to hang out. We've got a fitness center with a bunch of free weights and treadmills. And just the vanities as well as the kitchen. It's not so common to find a property with this kind of finishes in this market. It's got a great mix of unit mix. So we mostly 2 beds here, as you can see on the graph, the right side. We've got a few 1 beds and a few about, I think, 16 3-bedroom townhomes there on the property. $1,250 a month is the average rent currently on the property. And the next page here, we'll go through more of the market. So one of my favorite parts about this property was the fact that this has been a high growth area. And what's driving this growth really is due to this River Ridge Commerce Center. It's about 3 miles away as a crow flies. Maybe it's 5 miles away as you drive from the property itself. And there's over 80 firms that are coming in this section here, this 6,000 acre development. 12,000 of the 18,000 jobs have already been created, and there's more room to expand from there. But Louisville last year, because of this, led the nation in rent growth at over 5%, and still today they're outpacing the national average in rent growth too. So that's one of the big factors for me. We look for properties and areas that have strong job growth, which creates more demand for the housing in those areas. Another area I think to be considerate of is the difference between Indiana and Louisville, Indiana and Kentucky. Indiana is more favorable to live in due to its lower cost of living, better tax treatment, better for businesses. For us as real estate owners, we love buying properties in Indiana opposed to Louisville or Kentucky because we can get a lot lower property tax reassessments or less chance thereof if they're in Indiana. If you're in Kentucky or Ohio, you're going to be assessed upon sale right away 100% typically. A lot of the growth from the Louisville MSA area, which does encompass part of these southern Indiana cities, most of the growth has come from the southern Indiana area with Sellersburg, Clarksville, Jeffersonville, and New Albany. And then lastly, we do have a moratorium in place right now for new multifamily developments within Sellersburg and some of the surrounding areas. That was in place last year only. They have now renewed that for this entire year. So that is going to place serious pressure on whatever units are currently constructed in the area. And when we have more jobs coming in, you'll see more demand for the housing here that's currently being built. Chad, give us a little bird's eye view here in Heritage Square and the layout.
Yeah, so as you can see, kind of the bottom left hand of the screen, that's Heritage Square. I would like to kind of highlight the fact that right next door is a retail center with a grocery anchor, JC Food Stores. It's like the kind of the only grocery store right now in this exact area, and you're within walking distance for all the tenants. And I think that's going to be a big feature, kind of in any apartment community that I'm always looking for. If I can, how close are we to the retail node that everybody wants to go to, and especially grocery stores? That's a big necessary item for residents or anyone living in the area, and being that close is really beneficial. Also, if you go out towards Ivy Tech Community College, you kind of see that bigger exit interchange. That's to get on I-65. So you're a minute off the major highway and stuff, not right off of it, with kind of that visibility, but you've got major visibility on those two major roads, intersection there, and a very quick drive right off the highway that you can then jump on to get down to downtown Louisville. As Chad said, it's only like a 8 or 9 mile drive, very short distance to get into downtown, shorter than most, or on the other side of the suburbs in Louisville. And then, as you can see from the arrows kind of pointing around where downtown Sellersburg is, the River Ridge Commerce Center out towards the top right there, which is effectively the southeast of the site. And then there's some more jobs towards New Albany and Clarksville area as well.
Awesome. Thanks, Chad. Yeah, some big companies here that are moving in this area. People like Amazon, Samtech, Ford. You mentioned this already, Chad. This would be a great area here for all the residents. We have some rent comparables to show you guys as well, kind of show you where Heritage Square, the current property, how it lines up to the other comparable properties in the area. Chad, we cover this as well, please.
Yeah. So I think when you kind of look at this stratification of different comps, there has been we're always focused on the newer supply here as that's the more comparable property. These are pretty well spread out across the area. You can see where our rents stack up on the 1 beds, the 2 beds, and the 3 beds. Especially in the 2s and the 3s with those townhomes, we are much larger. And so when you look at that 700 square feet on our 3 beds, there's no one else that's really kind of close to us. And so we think that we have a lot of room in that way to move. We obviously show that with the 1 beds that there's a lot of room that we can move up there. And then the 2 beds were pretty in the center, but again, we're only trying to move up about $50 to $75 per unit on our average rents. And then when you focus in on kind of on the top of that sheet, you can see where our average market rent kind of sits. And many of those newer comps that we're comping to, the Walcott or Jefferson, the Jeff on 10th, Slate, these ones are, at 1450 to 1500. And we're just trying to, move up just slightly to 1290. 1290 is the goal rate, right? But we think that there's definitely room beyond that to move a little bit closer to them, get over 13, maybe even 1400 in the years to come. And then you can kind of see where the floor is set with like a Greenbrier as a 2010 vintage. And I think the other thing I'd like to call out is kind of the occupancies across the board. And you have varying degrees, whether it's a newer vintage deal, the Flats at Rivers Ridge is a brand new deal, or the Laurel's a brand new deal, still going through lease up. They're experiencing that because we're coming out of the tail end of all that supply being delivered, which is why Heritage experienced that same thing and why we're able to get it at this basis. But as Chad laid out, moratorium's been in place for a year, going on another year. We are seeing from census data that construction starts have dropped 60, 70%, and that's going to continue with the moratorium. So once that gets absorbed, and we have seen record absorption across the country and in this area, and the rent growth still there, we should start to see occupancies pick up pretty quickly, and then rent growth come right behind that. But we think this is the story of the area right now and why we're able to get it at the buying opportunity that we've been able to get it at.
Awesome. Thanks, Chad. We've got a quick map here for you guys to kind of show where those rent comps are located at. We do have a couple here that are nearby our property right here in the middle, near number 1, 5, and 10. We've got a concentration here more towards Jeffersonville and Clarksville. So you can review those as well on your own time. A quick overview of the financials. So it's a very important note just to be disclosed here to the source of uses. So we're going to be getting a loan here with Fannie Mae, that is a fixed rate loan, 5-year term, 24 months interest only, and we will not be above 70% LTV on this asset. We are raising $11.3 million to fund this acquisition. There will be a general partnership co-invest amount. You see here at the bottom right, I believe 7.5% or greater of the equity amount. As personal cash, I'll put in along with my partners as well. There will be tax advantages here on this property with bonus depreciation. We'll do it for year 1. Back to the top left, there are a few fees we want to disclose to you as well. We do have a fee upon acquisition of 1.5% of the purchase price. That is below market standards. We will be collecting a 2% fee of the effective gross income of the property for asset management. It goes to pay our team to manage the property managers throughout. There'll be a loan guarantee of 1% of the loan amount. We have a refinance fee here of 1%. That's not really going to be applicable because we don't plan on the refinance here at all. It's a 5-year loan term. We probably wouldn't refinance at year 3 or year 4 unless something crazy happened and we had huge valuation increases. But it's then in their case we ever do that, and there will be a disposition fee of 1% in the property when we sell that. We are calculating that for operating costs, we'll be at $1,600 per unit in payroll, insurance $455 per unit per year in insurance. We actually have gotten quotes back far less than that. This year is being very conservative, and taxes at $1,800 per unit. Chad, anything else here to add on this page?
I think you summed up pretty well.
Oh, I think one more point too would be we do have plenty of reserves on the property. One of the biggest things we'll look at on a property and a sponsor is, do they have adequate reserves to withstand any kind of storms that may come up? We do have CapEx reserves of $275K on the property. That's 1%. We do also have operating reserves of 1% as well, of about $300,000. So we'll be very well capitalized to be able to withstand any kind of financial storms that may come up. Performa, a lot of numbers here, but let me point out a few things for you guys that I think are really important. As Chad mentioned before, one of the common questions we've got so far is on the expense growth. And people have asked, well, why in year 1 are expenses growing 31%? And to give you a really simple answer to that is, when somebody self-manages a property, typically they don't charge a payroll fee to the financials, meaning that it's going to show 0, as it does here on this report. Now, when we professionally manage a property, there is a payroll fee, and you have to do it right to manage it well. And sometimes as well, when you self-manage a property, you may not do certain repairs or may strip out certain things to keep it running on a low budget. We feel like those things are actually needed going forward. We need to spend the money with marketing, with admin, with the right people in place to manage it very, very well to keep growing the operations. We have factored in a 3.5% rent growth year over year on average. We feel like that is conservative. With the Louisville MSA market growing over 5% rent growth last year alone, we do feel like this is and with the moratorium in place right now, fewer units coming online, we feel like 3.5% is very conservative for this market. Chad, you want add anything else to this page?
No, yeah, the rent growth, as he kind of laid out, 4 to 5% is already what's being shown. There's rent growth trending this year. We have that ramping up. That's an average over the course of time. So we have that ramping up and coming back down with the coinciding of kind of the supply deliveries and where those will peak, which we think was last year into this year with actual deliveries. Starts, though, will fall off or have already fallen off a cliff. So I think, yeah, that pretty much sums it up.
Okay, thanks, Chad. I want to give you guys a quick overview on Focus Capital, so you have a good picture for those that are new to the group here and who we are. We're looking at Fishers, Indiana. We do have quite a few properties under our belt already. This will be our 10th deal so far we've done. We've exited 3 properties already with exited returns. Those will be here in a couple pages coming up here. But I think it's important to note that our mission is really twofold, and our mission has become very clear, and that is our mission is to impact 1,000 families through real estate investing, giving them more financial freedom and more financial independence. And also, our passion is to impact 1,000 of our residents with financial literacy courses. And we're in the process right now of actually delivering our first ever program to our Kokomo property here in a few weeks to give those tenants free access to the Dave Ramsey program, to give them more financial awareness and wherewithal to help them with their current finances. So that is our mission. That's who we are. We do focus right now on Indiana properties only. We have expanded now into Ohio and Kentucky as of this year. We're going to still stay close to home within about a 3-hour radius. I want to share with you guys a couple case studies of properties that we've exited already. Exited means we bought the property, we did the business plan, we improved the value, and we sold it. I think it's very important that you look at a sponsor's track record as far as what they've done with their properties. We will be having more properties being sold very shortly, we hope. For this one here, we had bought a 20-unit property. This is actually a personal property that I bought back in 2021. And we sold it 2 years later, almost 2 years later, for 105% return, which was We knocked it out of the park. It was a home run for sure. I didn't think it'd go the way originally, but it ended up being a really good deal. We bought it right. It was very well maintained property, and it was under rented. And we were able to do some light renovation in the property, add some laundry units to some of the units there, the laundry closet, and we're able to get a lot higher rent on the property and make it more appealing to a different demographic type. This here was my third property that I had acquired. Now the first two, here's the second one that I bought, and we exited this after 2 years. This one had a lot of mistakes on there, a lot of lessons learned. That's why I chose to use my own capital first, risk my own money first before I ever risk somebody else's money. We still ended up getting a 16.2 average annual return, which is not terrible, but it should have been probably a 30 when it's all said and done. But exited that property, that was in Crawfordsville, Indiana. A lot of lessons learned on that property, and it was a great experience there. So what is next? Let me give you guys a couple more pieces of information here. As far as the timeline goes, that'll be the next slide, actually. As funding goes, Focus Capital team does all the work, as you may have known in the past. We find the properties, we analyze them, we do all the work with reporting to you, with distributions every quarter, and then we asset manage the property managers ongoing any kind of construction projects on site. Starting Q3 of this year, we will plan to distribute capital to our investors. That'll be that year one average 6% cash on cash return. And also your other part of your proceeds will come when we sell the property or refinance down the road. Reporting, we do give the K1s out from our CPA. Our goal is to get them to you by March 15th. They usually get there on time, might be a week later, but plan to get them out before April 15th for sure. And then our main goal here is to over communicate with our investors. We feel like communication is so important and transparency is important, and we want to deliver the good news and the bad news to you. That way you're always informed. So quick timeline. So where we're at right now is we've actually already done our due diligence walks on the property. We've done the unit walks to every single unit. We've done our inspection with the third-party companies. We've been on site. We've done a lot of the homework on the financial part of the due diligence. Our DD period is going to expire here in about 3 weeks, April 15th of this year. And then we're going to close the investment funding late April. We had put April 21st here on the deck. It's probably going to be at that date or maybe April 25th is my guess to close funding. We are planning to close early May, between May 5th and May 15th. And we will target the first distribution September of this year with a sale in year 2029. So at this point, let's open it up for any kind of Q&A that you guys have. If you're thinking the question, somebody else probably is as well. If you're already ready to have your questions answered and you're good to go, you can scan one of the QR codes here on the screen, and you can go to our easy use portal at the top right one. If you have questions still, you can book a call with me directly at my meeting link. That's the bottom QR code there. So I've got one question so far and a couple that were emailed over. Chris, is the population in Louisville expected to grow? Chad Olsen, take that one over.
Yeah. Yeah, it's still continued growth with the jobs. You got UPS headquarters down there, more expansion on that River Ridge Center, other jobs getting announced, and then just kind of looking as a general search, we had almost a 1% increase last year. It's trending that way for this year, and then the U.S. average was kind of about 50 to 60 point, or half a percent to 60% of a percent. So it's beating the national average in growth.
Okay, thanks, Chad. Chris, hope it helped you answer your question there. I had one question emailed to me a little while ago, and that question is, tell us more about the backstory on this deal and how this came about and how we're able to get this property for such a low basis. And the question referenced like there's maybe a question of like, is it too good to be true? Or how did you get this kind of a deal when it's so hard to find deals that are this good these days? So Chad, you want to tell more about that?
Yeah, it is a little bit longer than a longer story, but
2 minute story.
Basically this has been kind of around for over a year, about a year. They were originally shopping it around off market. They were looking to get over 200,000 a unit. It wasn't near this stabilized at the time. Occupancy was probably 50, 60, 70%. And they just weren't getting those offers. They eventually took it out with another brokerage this time last year. Went out to market. They did get a variety of offers on the properties, but those offers were about 20K lighter than what they were looking to do at the time, which was about 180 to 170, which is that range that we've talked about a lot today. And for whatever reason, don't know, but a business decision was made from the sellers not to execute at that price. So they went off market. We thought it would have been gone. The properties, disappeared and they'd sit on it for a while or whatever else. Well, the brokers that we have a very good relationship with, have done a ton of business with, they told us late in the fall, hey, listen, we're going to be bringing these deals out to market. Okay, yeah, that sounds great. We weren't near that price last time. Let us know what goes on with it and where it's going to trade at. And we kind of just kept on it. And when they came out, we weren't near their price again. And they eventually came to me in November and they were like, hey, listen, we're coming down. I think we can get a deal done at this one. And we just made our offer, right? We just like we had been doing all year. We made our offer what we could pay and what made sense to us. And eventually that margin started to reduce. And we eventually got to this 146K a door number. Now, even that being said, from November up until Christmas time, we got beat. We got in best and final. Another group came in over the top of us by $500,000 and several million, a lot of hard money on day one that we weren't super comfortable with doing. And we lost out. And then come January, came back around again, gave us another opportunity where we were able to get a little bit of a discount, even to the original price that we offered and we're comfortable offering with in the end of 24, and got it under signed LOI, got it under contract. And so it's really just a testament to being on the deal all this time, sticking to what our number is that makes it work, and letting the market kind of say where this should be. And we've gotten calls and other groups have gotten calls to, hey, why did we miss this deal? Why didn't we see this deal? We didn't know that this deal could trade at this price, because the pricing guidance was always so much off. And so we got to stay in the mix, and that's what we're trying to do.
Thanks, Chad. I had one more question that came in here. Why would the current owner sell off in year two? That's a pretty easy one for me to answer, really. Different builders are either merchant builders or they're long-term holders, like legacy holders. And this one is more of a merchant builder, meaning their goal is to go find the property, the parcel, develop the buildings, lease it up, get it stabilized and sell it and go to the next one and repeat. So they're more fee driven, they're just to kind of sell them and flip them and go to the next property. They're not necessarily, their strength is more in the building process, maybe not the management process. And they may not even want to be managers altogether. And a lot of builders and developers that don't want to be managers at all. They want to be just the builders or developers. So that's the story there on this property, is why they're selling right now to go to the next property, new project. Okay, any more questions here? I had one question as well that came in. It says, why is it rare? I think I covered this in the initial part. So the rare part of this really comes down to the price per door we're getting it at, and the positive leverage going in. It's very rare to find a Class A Core Plus property with positive leverage, meaning the interest rate is lower than the going in cap rate, what that does for you is then it provides more downside risk protection and more cash flow out of the gate. So it's pretty rare to find that in a Class A new asset. Typically, like Chad said, and a Class A new asset is going to trade probably a sub 5 cap or a 5 cap, which is a higher price. So we feel that to have this new property at this price point is very rare. Okay, if there's any more questions that want to be submitted, go ahead and do that. While we're waiting here for a minute, I'll give you guys next steps. After this is all over with, I will send out a replay today of the webinar to your email. I'll do it to our total distribution list. In that email, I'll also include a link to register at the portal if you feel like that's the right fit for you. If you still have questions right now from me, you can call with me directly. My schedule is opened up. I'm happy to get the call with you one-on-one and go over those calls in person with you as well. Well, awesome, guys. So I want to thank you all for your time today on a Wednesday afternoon around lunchtime here. I know it probably wasn't easy for everyone to get on board, but thank you again for your time. And if you have questions for me at all, just let me know. And again, have an awesome day. Thank you so much.